Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to the Money Marketing Podcast. I'm Kimberley Dondo, and in today's podcast, I'm joined by Janet Mui, Head of Market Analysis at RBC Brewin Dolphin. Thank you for joining me today, Janet.
Thanks, Kimberley, for having me.
Okay, so Janet, could you give a bit of a background on you and how you got started out in financial services?
Yeah, sure. So I'm currently head of market analysis at RBC Brewin Dolphin, and my background is actually a macroeconomist. So I joined Cazenove Capital for 9 years, and I was the global economist. So basically tracking economic developments and linking that to investment strategy. And I am very lucky to join Brewin Dolphin as an investment director. So my role was to similarly looking at the macro picture, but talking to clients more often and also being a spokesperson for the company. So going to various media interviews regularly. And I love economics. I studied economics during my undergraduate. Yeah. And I also have MBA in finance as well.
Yeah, wow. So you have a breadth of knowledge, especially on the topic that we're about to talk about right now. So I'll just kind of get started with the questions that I have. And I think first up, we can start by asking, how would you assess, the surprise 50 basis point rate increase delivered by the Bank of England, and what implications does it have for the overall market and the economy?
Well, I think, yes, it was a surprise, but not too surprising. I think we got the 50 basis point after the higher than expected inflation figures in the UK. And then the wage growth figure was very strong as well. So I think the Bank of England is clearly behind the curve and behind, say, the Federal Reserve in raising interest rates. It has been making smaller moves compared to, say, the Federal Reserve. And I think it is playing catch up. So I think, it was a bit of a panicky move, and I think they actually put out a statement and they sounded a bit empathetic to the situation. They know that this is going to cause more pain for households. They highlighted that, yes, we know this is painful, but we have to do it because we have to bring inflation down. So I guess we'll just have to expect more rate increases from here because inflation is just so much higher in the UK.
Yeah. And I guess we'll just be feeling that pain for a bit longer. And you previously mentioned that the Bank of England's decision to double down on its fight against inflation comes after, red hot inflation and wage data. So how do you interpret the current state of inflation and its impact on the economy?
Yeah, so I think, as I mentioned, the inflation figures in the UK is particularly high and sticky. And I think there are a number of factors. First of all, is the energy story, right? We have this peculiar price cap mechanism that makes the transmission of lower wholesale energy prices much slower in the UK. So I think that really is one of the factors. We are seeing higher than expected inflation. And the other one is we have a very tight labor market. We actually lost a lot of workers, right, during the pandemic. And they're slowly coming back, but not as many has come back as people have hoped. So it has driven up wages. Our wage growth is much higher than in the US at the moment. I think that could be due to Brexit. That could be due to the pandemic, a lot of structural impact there, which makes inflation harder to come down. And of course, there are other factors which, like Brexit, there are lots of red tapes. particularly in the goods trade side of things, that fundamentally makes inflation harder to come down. So I think the impact on the economy is that, first of all, high inflation is very bad for the economy. Households are more squeezed. They could spend less after eroded by inflation. And also with the higher interest rate that we are observing, it is going to have a bigger toll going forward. I mean, we're not actually observing most of that detrimental impact yet, because we have many mortgages that are on fixed terms and they have yet to come to refinance. So we have to acknowledge that going forward, when more and more households refinance, that would be increasing negative impacts on consumer spending. So yes, I'm afraid if interest rates were to keep going higher, so a lot of people expect now interest rate may go up to 6%. So if we reach that kind of level, I think a recession is very likely. Yeah.
Okay. So you mentioned before that the Bank of England has been a bit slower on the take compared to, the Federal Reserve, as you said before, and they have faced quite a bit of scrutiny and doubts regarding their forecasting credentials. So in light of this, how does the rate hike reflect on the Bank of England's commitments to its mandate?
Yeah, I mean, I have a bit of sympathy on the forecasting ability of the Bank of England. Obviously, it has been terrible, but we also have to acknowledge the economic situation has been so uncertain. Look at the fluctuations in the wholesale gas prices. It is very hard for them to predict. And also, they only update their official forecast, like once a quarter. They can't keep up with, say, the sell-side economists that can update their forecast anytime they want.
Right.
So, I think there's a bit of that. But ultimately, we also feel that they have been slow in hiking interest rates. They should have done it faster and earlier. So I think they lost a bit of credibility on that. And also, I also feel that they do know that the UK is very interest rate sensitive, as in some of our mortgages are 2-year fixed, for example, whereas say in the US, most are 30-year fixed mortgages. So the interest rate pass through will eventually come. They know that it is going to cause pain. So I think that's why they have been a bit more considerate previously, because they want to manage the inflation without a recession. That's the best hope. So they have been considerate, but ultimately they realize it is difficult. So that's why they are now, going to be more aggressive, because they already highlighted, sorry, it is going to be painful, but we have to do it. Yeah,
that makes sense. And you previously were talking about mortgage holders and what the consequences might be further down the line. But for our audience of financial advisors, when they are kind of dealing with their clients who have floating rate mortgages, or the ones who have fixed rates, who may experience the shock when it comes to refinancing later on, what would your words of wisdom be for them when they're talking to these clients in those situations, in those two kind of separate situations?
Yes, I think it is going to be a very difficult discussion. I mean, the interest rate, it is what it is. If you have to refinance, then you will definitely be refinancing at a much higher rate. It will be more difficult for your personal finances. And if you're already on floating rate mortgage, of course, you're having this periodic increase in your pain. So it is never an easy conversation, but it is important. I think for the remortgaging decision, or whether you want to fix 2 or 5 or whatever, it can be a pretty personal decision, I think. What we can tell clients objectively is that we can guide them where interest rates may be heading, right? So that is a more factual thing. So it is a difficult call. Obviously, we don't know what will happen, but we can do our best in referencing the market pricing of interest rates, for instance. And what we look at, for example, is the overnight index swap curve, and that basically gives an idea of what market thinks the UK interest rate will be from now all the way to the next 50 years. Of course, we don't need to go so far. We can focus on, say, the next 5 years. So we can tell them, for instance, right now, when I look at my Bloomberg screen, 1 year later, interest rate expected by markets is 6.1%.
Right.
2 years later, still high, still above 6%. But in 5 years' time, market think that UK interest rates will come back down to about 5.3%. So ultimately, we expect high interest rates in the near term. But if you look at a 3 to 5 year horizon, we expect interest rates to actually come back down, because inflation ultimately will have to come down. Either we have a recession and inflation will have to inevitably come down. I cannot foresee inflation being at this kind of 8% level year after year.
Yeah.
So I think you can tell the client these kind of factual data that you get from the market pricing, and to see and what are their personal circumstances, what is their preference. So I think that's the first step we can communicate with them.
Right. Yeah. Definitely. All you have is your forecast and the figures that are in front of you. So I guess that makes sense. And it has been previously said that, the inflation beast is difficult to kill without the pain of a recession, which to some may be terrifying and bring back flashbacks from, 2008 or even earlier. So what strategies would you recommend financial advisors utilize to navigate the current inflationary environment and its potential consequences?
Yes, I think there are a few steps that we can take to communicate with our clients. I think, it is very important to reiterate that inflation is a beast. It is more important than ever that you have to review your financial situation. Your savings are being eroded by inflation, right? So take a look at the personal finances of your client. I think reviewing your income and expenditure is important. It will give you an idea of whether your plans are still achievable. You may think, you may find that your expenditure is still within your budget, and you can maintain or even increase how much you're saving each month. Or actually, it may be that you're overspending and you actually need to make some adjustments. So I think you need to review, sit down and take a deep look at your personal finances. So that is the first step, very important. And for savings, right? I mentioned savings is eroded by inflation. So what can you do? Right now, interest rates are actually better on offer, but it's still quite important to actually shop around for the best interest rate available, right?
Right.
So if you have large amounts of money, a difference of a few basis points, it can still have an impact on how much interest you can earn, for instance. And of course, with regards to savings, the rule of thumb is you at least have 6 months worth of essential expenditure saved as an emergency fund. So that's unchanged. And of course, you can keep it in an easy access savings account where you can instantly withdraw if it's needed. However, I think to fight inflation, anything above that emergency fund, I think you should consider moving that portion into investment, because over time, historically, time and time again is proven that the most effective investment that can beat inflation over a long period of time, it has been equities, for example. But of course, you have to be very comfortable that your investment may fall or rise in value. But I think it's really worth communicating to your clients that to fight inflation, you need to have some portion of your funds into a risk asset, for example. And for example, once you have considered where you invest your money, how much you save, then you consider the tax efficiency of your portfolio, right? And of course, we all know ISA and pension are very tax efficient instruments, which can help boost the future value of your savings and investment. So I think these steps are pretty fundamental.
Yeah. And I was looking through your LinkedIn and all of your qualifications, which are very impressive, by the way.
Thank you.
But I did notice that you do have kind of an interest in ESG as well. So this is kind of a curveball I was just throwing out there. I just wondered what your thoughts are on ESG funds during this time. Are they impactful when it comes to people's investment portfolio, or do you see people taking a step back from their care for ESG?
Yeah, I think generally our investment process at RBC Brewin Dolphin, we incorporate ESG into our portfolios and investment process, but it is with varying degree. So our overall investment process take into account ESG because fundamentally we think that ESG adds value to your long-term investments. Because if a company is scores high on governance, for example, you can have a reasonable prediction that this company is well managed.
Yes.
And there's so many environmental risks out there. And if the company actually tries to manage the transition to net zero, they avoid environmental risk, they potentially future returns could be better. And you may be penalized if you actually don't care about the environment or you don't care about the social aspects, right? So it's embedded in our investment process. But for those clients who are particularly interested in ESG, then of course there are investments that cater for that, which, for example, there are specific considerations that you invest purely in companies that score very high or that aligns with your ESG interests. I think those, to be fair, those funds or those stocks, it hasn't done as well in the past year or so because those stocks are generally high growth areas, because ESG is generally providing a solution to the current world problem. So those are usually more innovative, more growth type of companies. So that's why you may realize those funds or stocks haven't been performing as well. But I think, 1 year's performance is not going to dictate what is going to be the long-term value. So I think we still believe that this is a factor that is very important. And over the long term, it will continue to generate good returns. But I think overall, it really depends on how deep you are into this ESG commitment. There should be a range of solutions that should be on offer.
Yeah. And so finally, in light of the evolving economic landscape and the likelihood of further rate increases, as you mentioned, how can financial advisors effectively communicate and prepare their clients for potential market volatility and economic changes or economic challenges? I know you mentioned some techniques before, but is there any other aspects they can be tapping into?
Yeah, absolutely. So I think, first of all, the investment challenge, right? So rising interest rates is generally considered negative for risk asset. We've seen equities, for example, falling in value, and actually bonds as well last year, right? But in the grand scheme of things, it is not going to change the case for long-term investing. Right. So we have to understand and communicate that the economy tends to go through various stages. It is a cycle after all. Sometimes it can be there are good times and there are bad times. And I think the gold standard of how we navigate these uncertainty and volatility is to have a diversified portfolio. I know it may seem a boring advice, but it works. And it basically, a diversified portfolio is investing money across different regions and asset classes, right? And history shows us that long term, these asset classes tend to perform better than just holding your money in cash. So it can mitigate the impacts of rising inflation over time. So I think while diversification is absolutely important, which I believe many advisors are already doing for their clients, but it's always worth taking a review. And also, I think it's very important. It's very natural to feel worried about the impact of economic events on your portfolio, right? I think we have been through COVID times when markets were in a bear market in a very short span of time, followed by a quick recovery. We have been through the war in Ukraine where gas prices rose 10, 20 times, and then now back to where it was. So we have to understand these volatility happens, but it is important not to make a hasty decision, which potentially can cost you in the very long term. So I think, we can never foresee these kind of shocks, but that's why we mentioned at the very beginning your emergency cash fund. If you have time and the cash set aside, you're investing, it can stand the test of time. So I think that's a very important message. And I think for retirees or people who are going to retire, this is obviously going to pose a bigger issue, right? So inflation and the market volatility. So I think that's another consideration that financial advisors need to take particular care. So I think it means that it is very important for financial advisors to do check the financial health check for these people. I think they need to, for example, they can take advantage of financial planning tools like cash flow modeling that will give you a better picture of how inflation can affect your clients' savings and spending, and are they going to last throughout your retirement. So I think the more information and the clearer the cash flow picture that you have, the better you can assist your client in adjusting their financial plans and planning ahead. So I think it is particularly important for retirees.
Yeah, definitely. I could not imagine thinking that I want to retire in a year or so and looking at the landscape and just being terrified, but having a good financial advisor to navigate that using cash flow modeling would probably ease some of that. So definitely very good advice. But thank you so much for speaking with me today, Janet. I really enjoyed this conversation.
Thank you, Kimberley. I enjoyed the discussion a lot. I hope it will be helpful to all the financial advisors.
Yeah, definitely. Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.